It's recording this video.
Yes, I'll upload it in YouTube, right?
Give me the channel.
Yes? Yeah, I'll send it to you.
Yeah.
Okay. So let's so as we have discussed, NCA is something that you buy for more than 1 year, right? Buy and use for more than 1 year. Okay? And when it comes to NCA, here in this chapter you're going to study about how to depreciate it, okay, and how to actually measure the values, okay. I'm going to explain how you do it in both ways, that is by logic and by ledger. Clear? Okay, so what are the characteristics of non-current assets? It's long term in nature, right? We use it for very long time, okay, and it is not acquired so that we can sell it, okay, and it is tangible assets are of two types, okay. One type of asset is that we can see and touch, that is tangible. Clear? Non-current assets are of two types. One type of asset we can see and touch, for example the laptop that we use, the car we use, right? And the intangible asset is such that you cannot see or touch, okay, but it is there. For example, patents, okay, example some agreements, license, all these are intangible assets. Clear? Okay, and these assets actually bring in revenue or income to the company directly or indirectly, okay. Sometimes non-current asset could be used for renting purpose. Sometimes the non-current asset that you use could be for your administration purpose. For example, your office that you use, right? It is generating income indirectly. Clear? Okay. And the last thing is that these non-current assets are not liquid assets. So what is a liquid assets? Any asset which can be converted into cash right away or are in nature of a cash is called as liquid assets. Clear? But non-current assets is not assets are not something that you can directly convert into cash. Understood? Clear? So in order to convert it, you may incur some losses. Hence, non-current assets are not liquid in nature. Understood? Next one, expenditures. Okay, so there are basically two types of expenditures that the company does. Okay, one is the asset expenditure, the other is just the expense. Okay, so what is asset expenditure? Suppose you have bought a car, okay, and this is used for delivery purpose, okay, and due to that delivery purpose that you have bought this car, your income is keeping on increasing because you are getting more and more order, right? So whenever there is a returns or an economic returns for a type of expenditure that you do, that type of expenditure is called as asset expenditure. Understood? Suppose you are running a travel business and you have bought a bus. Okay, this is an ordinary normal bus. And onto that bus you have installed AC, air conditioning system. Clear? And before that you had less number of customers, that means your customers were relatively lower than the others, okay. But since you installed AC system, your sales plummeted or your sales increased. Understood? So in that case, by installing or by buying some or by doing some expenditure, you have got extra economic benefits, right? Because your sales increase. So that is also called as asset expenditure, or in other words we can say that subsequent expenditure. Understood? Okay. Now suppose you have done an expenditure, okay, but it is not generating you any extra income, it is not generating you any income for the matter, but it is maintaining the existing income capacity, then that is called as an expense. Understood? For example, when your bus's brake is down, you're going to repair it. Is it going to generate you extra customers? No, right? It is just going to maintain your existing customers. Clear? So all of those things which does not increase the earning capacity of a business but maintains it is called as an expense. That is taken into SOPL. Clear? Whereas this expenditure is taken into SOFP. Understood? This is asset expenditure, right? This is taken in SOFP, like a normal asset, NCA.
Expense.
Asset expenditure.
Okay.
This is taken in
this-
SOPL.
Okay.
Understood?
Okay.
Okay?
It's it will be like a kind of asset.
Yeah, asset.
Right?
It is asset itself.
But it will be like not kind of expense, it will be still asset, right?
Yeah. It's not expenditure, actually it's an asset, but IAS is telling you that we are going to group these expenditure into two parts: asset expenditure and normal expense. Clear? Okay, it's nothing confusing. They are just bought in unnecessary terms. That's all. Clear? Okay. Next is not.
I'm sorry. I think I missed that one question. That tangible, it's touchable, and intangible. For example, which kind of what can be?
Tangible can be our car, our building. All of these are tangible items, right? Intangibles can be a business license. Those are intangibles, right? It doesn't have a physical existence. Understood? A license doesn't have a physical existence. So if there is no physical existence, that is intangibles. Understood? The ones we cannot see and touch are intangibles. The ones that we can see and touch are tangibles.
Like some intellectual property, something like
Yeah,
that, right?
yeah. A software. A software is intangible. Clear? We have a separate chapter for that. We will be coming to that later on. Okay? Next one, non-current asset register. So we are talking about big companies. So big companies have different types of non-current assets, right? And these all should be accounted for. Okay? So there would be an asset register or a file which contains all the details about whatever is concerned with the non-current assets, and that is called as non-current asset register. Understood? So in that register we have cost of the purchase, date of the purchase, description of the asset, the serial or reference number of the asset, the location where the asset is, the depreciation method used, the expected useful life. Clear? The carrying amount or net book value of the asset. Clear? Understood, no?
Yes.
Next is acquisition of a non-current asset. So when we talk about every other standards, there are two types of measurement that is going on. In IAS 2 as well, we have discussed that initial measurement, right? That is measurement at the beginning of the year and measurement at the end of the year. Clear? So same way, NCA also has that sort of measurements. Clear? Okay. So measurement, when you do it initially, that is at the first place, what you're going to do is you're going to take the cost of the purchase and you add every other expenses that you incur in order to bring that asset into working condition. Understood? Okay. So purchase cost is there, delivery cost is there, legal fees is there, subsequent expenditure, that is bus, that we bought a bus, we installed air conditioning system, so it should be added. And this method of adding this subsequent expenditure is called as capitalization. Clear?
This capitalization, I'm always thinking, what is this word like?
Yeah, capitalizing. The method is called as capitalizing, that you add with the asset. Clear?
It means increasing the value of the
Yeah,
asset, like
yeah. Increasing the value of the asset due to some additional expenditure. Understood? Okay. Next is whatever cost that you have for testing that asset, you're going to take that as well. So all of these things together becomes assets value. Now, what shouldn't be taken? That is, what should not be included. First thing is repairs and renewals, because it is just going to maintain the capacity, so you're not going to take it. Repainting and redecorating, again, expenditure, normal expense. Administration expense, normal expense. General overheads, normal expense. Training cost, normal expense. Wastage is normal expense. So all of these costs shouldn't be taken. Understood? Okay, and we have done so many journal entries before, so the same journal entries apply. When you're going to buy a non-current asset, you're going to debit it because it is group 1 in nature. When it increases, you're going to debit it, right? Now you don't get this for free, you have to pay back an amount, or you have to tell them that you will pay back in the future, right? So credit, bank, or payables. Clear? Okay. And yeah, the normal journal entry that we do. Okay. And when it comes to assets, all the assets with separate category would have separate ledger accounts. That means everything should be recorded, that is individually. It shouldn't be recorded all together. So for motor vehicles, we have a separate account. For fixtures and fittings, we have a separate account. Understood? Now next is subsequent expenditure. As I've told you, when you have an existing non-current asset, you put an AC system to it, you get extra benefits. That is called as subsequent expenditure. Understood? Okay. And then again, subsequent expenditure is also asset in nature and normal expenses. The normal expenses are taken in SOPL. Asset in nature is capitalized with the asset. Clear?
This is
The same thing that we said here. Clear? Okay.
It will go capital, I mean, for expenditure asset.
Pardon?
Yes, it will be like capital asset.
Yes, suppose I bought the bus for 10,000. Okay. I have spent 700 for the AC. Now AC is going to bring in more income for me, right? So now my asset value becomes 10,700. Understood? So this process is called as capitalizing. Suppose I have bought the bus for 10,000. I repaired its brake for, let's just say, $100. But I'm not allowed to take this here. I have to take this in SOPL as an expense, repairs and maintenance. Understood? So that is the difference between a subsequent expenditure over the asset as an asset expenditure and as a normal expenditure. Understood? No? Next topic is depreciation. Okay. So depreciation, to be simply put, suppose you have bought a car for $5,000. Okay. After 5 years, you have decided to sell this off. Okay. Now, if you are going to sell this, would you get the same amount of 5,000 next at that time? Would you? No, right? You're not going to get it. So this particular valuing down of the asset should be done on a gradual basis, on a systematic basis, and it is called as depreciation. Clear? Understood? So depreciation, simply put, it could be taken as you're going to take the cost and split it between the useful life of the asset. Clear? Okay? In other terms, you can also take depreciation in a different level altogether. That means you have this car $5,000, okay, and you know that it could be used for only 5 years, after which the car's working gets so deteriorated, so that such that you can't use the asset. Right now, you need a replacement. Okay, so instead of taking the assets money then and there on by 5 years, what you're going to do is you're going to make some amount of money away from your business, okay, or take some amount of money or accumulate some amount of money in order to replace that asset. Understood? So depreciation also can be a replacement cost. Okay, depreciation could also be something that is used to show the damage that is being done to the asset. Clear? So all of these definitions include depreciation, but IA 16 says that it is a systematic allocation of depreciable amount over an asset over its useful life. Clear? No? Understood? Now,
Yes.
there is a dual effect when depreciation happens. The dual effect is that it is going to have taken to the SOFP deducting from the asset cost. Clear? Okay? That means if the asset is bought for $10,000, there is a depreciation of, let's say, $500. Okay? Then the assets amount is now how much? 9,500, right? This is called as carrying value of the asset or carrying amount of the asset. Understood? So in order to reach the carrying amount of the asset, you're going to deduct the depreciation off and calculate the amount. Clear? No?
Carrying what you're saying?
Carrying value or carrying amount. From the cost, you're going to take away the depreciation in order to reach the carrying value. Clear, no? Understood? Now,
Yes.
the depreciation could be caused due to the use of the asset, due to physical wear and tear of the asset, due to passing time, the depreciation could diminish away. That means the asset value could diminish away, especially if it is a lease. Clear? It could be due to obsolescence or the asset being old due to the new changes in the market. It could be due to the depletion. Depletion as in it is concerned with extracting something from the ground. Clear? Okay. So all of these lead to depreciation. Now the one thing IAS 16 tells you is that, okay, for land there is no depreciation. Understood? IAS 16 says for land there is no depreciation. Understood?
For land.
Yes. Okay. Now next one, methods of calculating depreciation. So you have got two methods of calculating depreciation. One is the straight line method and the other is reducing balance method. Okay. For straight line method, every year depreciation is same. Okay. But reducing balance method, every year depreciation becomes different. Understood? In any way, depreciation on straight line method is calculated as cost of the asset, okay, minus scrap value, or we say residual value, okay, divided by useful life. Clear, no? Okay. If I tell with an example, suppose an asset is $10,000 and someone has estimated that the asset is going to have 10 years useful life. Clear? The asset is going to be sold for a scrap value after its useful life for $500. Clear? Now you need to find depreciation on straight line method. So that is equal to 10,000 minus scrap value of 500 divided by 10. Clear? That is 9,500 divided by 10 would be $950 per year. Clear?
Scrap value.
Scrap value is the residual value. That means that when you use an asset for a very long time, how much ever value you get by selling that asset is called as a scrap value. Clear?
I don't understand the point.
Suppose I bought this machinery for $10,000. Clear? And I have been using it for 10 years. Understood? So after 10 years, I want to sell this off. So at that time, that is up to the useful life, how much ever amount that I get in order to sell that asset is called as the scrap value. So here it is 500. Scrap means waste. Clear?
So you can sell him after 10 years only like for 500.
Yes,
okay?
yes.
But how you will
These are all decided by people who value these items. We are not concerned with that. We'll be the question is going to give you all of these amounts. Clear? Okay. So all the researchers and analysts are going to be the people who are going to value these things. But we are not concerned with this. ACCA people doesn't value things. See, valuation of assets is done by a separate set of certified experts. Clear?
So this scrap value and book value is same or is different?
Scrap value is different because you can't get a book value. Scrap value is the amount that you get after using that asset for the maximum period of time. For example, you have used a laptop for many years, okay, and when you decide to sell it, you only get $100 or so. Clear?
Okay, so residual value, scrap value same.
Same. It is both the same. Residual value and scrap value is same. Okay. And suppose you got 950 as depreciation, right? Suppose you want to depreciate for 3 years, you're going to multiply it by 3. 4 years, you're going to multiply it by 4. So every time you multiply, you get the amount of depreciation for 4 years, 3 years, etc. Clear, no? Understood?
Yes.
Okay. So straight line method, The calculation is cost minus scrap value or residual value divided by useful life. You get the depreciation per year. Okay. And the next equation is that cost into percentage. This also applies to straight line method. Clear, no? It basically applies to reducing balance method, but it also applies to straight line method. That is cost into percentage. Clear, no?
The second one, how to
Cost would be given in the question. Percentage to be applied would also be given there in the question. You just need to multiply both. Clear? Okay.
So cost I will multiply the percentage and after I will.
In this question, it is being given useful life, right? Instead of useful life, instead of this one, they are going to give you depreciated at 10%. Understood? Clear, no? Now,
okay, so
okay.
So from cost 10% will be depreciated, right?
Yes, yes. Next is reducing balance method. So in reducing balance method, as the name suggests, you're going to apply depreciation over the carrying value of the asset. Clear? Okay, I'll tell it within. I'll give the equation first. So first of all, first and foremost, at the beginning of the asset's time, it is going to be initially depreciated as cost into percentage. Clear? And then after that, you're going to use the carrying value into percentage. Understood? Example, an asset is there, it costs $1,000. Okay, and it is depreciated at 10% per annum. Clear, no? Okay, so initially what are you going to do? Cost 1,000. Okay, just a moment. So the asset costs $1,000. Okay, and they have said the depreciation is 10%. So the first year you're going to apply depreciation over the cost. Clear? That is 100, right? Okay, this is called as the carrying value. This is the first year. The second year you're going to apply depreciation over the carrying value of 900. Understood? Into 10%.
900?
Yes, that is 90. Understood? Okay, so 810. This is the carrying value. On the third year also, you're going to find the depreciation over the 810. Clear? So like this, when you find depreciation over the carrying value of the asset, is called as the reducing balance method. Understood?
So it will like this till which time it will be like?
Until the asset becomes zero. But usually they always tell you what is the depreciation charge. If the asset is bought for 2,000, what is the depreciation charge for 2005? Usually they tell you. Clear? Okay, and it is according to the judgment of the accountant that he decides whether or not you use the SLM or the RBM. Clear?
So
okay,
how many methods here?
two, just two methods: straight line and reducing balance method. Okay, now useful life is not it is calculated by someone, the valuation experts. They say that for an asset such and such a useful life is there. Clear? Okay, reducing balance method we have already discussed. Now the important part, this is really important. You have to be sure what your question says. Okay, so there are two ways in which you approach depreciation. Okay, the first approach is a full year depreciation. Suppose this is talking about assets which are acquired at the middle of the year. Clear? That means your accounting period is 1st Jan to 31st December. Okay, but you bought the asset on 1st July. Clear? So it is the middle of the accounting year, right? So how do you take depreciation? So there are two approaches. The first approach is that you're going to take full year depreciation but none in the year of disposal. Year of disposal means during the asset sale. Clear? That means you are not going to time apportion, you are not going to use month by 12. That's all. Clear? So in the question, if they clearly says you this is the treatment, don't month apportion the depreciation. That means you can't use n by 12. Clear? But if nothing is given, then you're going to assume that the depreciation happens and it could be taken as month by 12. So in this case, only from 1st July would you take depreciation till the 31st December. Understood? Okay, now whatever I am going to do next, you have to study this as it is. As it is means don't change any format. Clear? Okay. So in the question, you usually take the requirement first and then calculate accordingly. But in the first, but whenever I teach you the concept, you're going to calculate the full concept, and then when you do the kit, you can take whatever is being asked. Clear? Okay. Don't do anything. I'll give you time to do the question. But for now, just listen. Okay. Where a trader purchased an item of plant for $1,000 on 1st August 2001, which depreciates non-current asset using method at 20% per annum. Clear? Okay, so you're going to write it like this. On 1st August, follow the same whatever I teach you, same format, don't change. Okay, so 1st August 2001, you bought the asset at cost for how much? $1,000. Clear? Now you're going to find the depreciation, but it should be taken on 20% per annum, right? Accounting year end is 31st July. Right, so it begins at 1st August. Understood? Okay. Now the depreciation, you bought the asset for 2001, right? You need the amount for 5 years time. So 2002, 2003, 2004, 2005, 2006. So until 31st July 2006 is what you're going to find out. Clear, no? So the first year depreciation, 1000 into 20%. How much is it?
200.
1000 into 20%, 200. Clear? So the remaining is 800. And this remaining is called as carrying value at 31st July 2002. Clear? Again depreciated. 800 into 20%. How much is it? 160? Okay. So how much is it remaining? 740. Right? So carrying value at 31st July 2003. Okay. So 1, 2. Yes?
Here, 800.
Yeah, 640. Sorry. Clear? So 2 year depreciation is down. Again 3. Depreciation 640 into 20%. Right? So that is 128. So now it becomes 512. Clear, no? So carrying value at 31st July 2004. Understood? Again on the 4th year depreciation is calculated again on 512 into 20%. Don't do it, okay? I'll give you time. That is 102. Okay? And 512 minus 102 is 410. Clear? This is carrying value at 31st July 2005. Again, one more. Depreciation is equal to 410 into 0.2. 20%, right? So how much is it? 82. Okay. So that is 328 at carrying value at 31st July 2006. Understood? So when you talk about accumulated depreciation, what do? You're going to take all of the depreciation together and find the accumulated depreciation. Understood? Okay? Clear now? This much is okay?
So all this depreciating amount will be like accumulated depreciation.
Yes, we'll come to that. That is the next topic. Okay?